Hi, I'm Dave Poxon. I'd like to introduce you to a program that I'm running called the S&P 500 Flex Weight Model Portfolio Program, or Flex Program for short. The cornerstone of the Flex Program is an actively managed tactical allocation portfolio that investors are able to see all real-time buys and sells and the rationale behind all real-time buys and sells, along with the tracked performance of the portfolio. The portfolio consists of only two components: an equity component, for which we will use an active broad-based ETF like SPDRs or SSOs, and a cash component. Why do we only use two components? Pretty straightforward. The first answer is simplicity. In order to take advantage of different opportunities and to be a little bit more active, investors need to sort of be able to keep track of how the portfolio is moving. Unfortunately, investors do not always have the time to actively run or check on their portfolio. By only keeping track of one instrument, investors are able to manage their time better to keep track of things in a more organized fashion. The second reason simply is that if we only have one investment product that we're looking at in terms of tracking, the cost structure is more efficient, and again, it's more efficient from a time perspective because you're only making one decision and managing that one decision with that particular piece of or that particular ETF. The other reason why we track this is the diversification component of the S&P. Obviously, 502 stocks, major U.S. corporations, so it acts as a nice diversified portfolio holding that you can control and buy and sell actively in just one quick movement. And secondly, since 75% of most portfolio managers tend to underperform the S&P 500, that in itself tends to make a very good investment vehicle. Now, why would you, the investor, be interested in the Flex program? Well, the answer is simple: performance. The Flex portfolio program has significantly outperformed buy and hold. Remember what I said, most portfolio managers and most mutual funds do not outperform the S&P 500. The base model, algorithmic model in the Flex program outperformed the S&P 500 from 1997 to the current levels of 2015 by over 100%. And here's the beauty. We did it at a substantial reduction in risk, because from 1997 to 2015 there's been two major market declines that have stretched the course of many years, and they've dropped over 40% from the peak. The Flex program took you out of that particular model and allowed you to not necessarily be in the market, although there were opportunities to get into that market. Here's the 2008 financial crisis. Imagine, see that red line, and we'll explain the D2 process, because from this point here all the way down into this particular point, there was no opportunity for us to be necessarily into too many in the long trades. There was a long trade from this point right in here. There was a little bit of a long trade in this area in here. But the bottom line here is that this entire red line, you were out of the entire marketplace. And that's the same analysis that we can show you when the market was starting to sell off in 2000. In this particular case, and again, as we explain more detail what the D2 works, this was the actual point that we were looking to sort of get out of. So from a no trading perspective, we were actually making money up and down when the chop was in the market, because that's the tactical portfolio. But when the dynamic of the market began to change, we were actually out of the market and only using our sub indicators to give us some trading ideas. So that's the first reason, the performance of our product. The second reason is the ideas that I've been talking about here are scalable to other areas of the market. This is a really good opportunity for an investor to see and hear the logic real time as things evolve. And secondly, this is just the tip of the iceberg in terms of our performance. As you can see on the graphic right here on the right, what we have is we have different rating and ranking systems for all the industry subgroups, sector groups. So we can talk a lot about things like US dollar, and we will, and give you an idea. So even though you might be interested in the S&P 500, there's also other areas within our program that you can use this for.